All right. Today is Thursday, October 6th, and this is a recap for the stock market activities today. Now, folks, I got a good one for you tonight, but since I am running out of time and we have an important jobs report tomorrow, let's do a preview and what we should be looking for and expectations, what the market is going to do after we get the report in the morning. Let's go over a few indicators. Indicator number one is jobs openings, and you might have heard this week job openings went down. This is what the market is excited about because the market looks at it as, hey, Fed, all of this tightening that you're doing, it is showing results in the economy. Inflation maybe is slowing down here and there, and we're also seeing job openings moving down. So, hey, Fed, Papa Jerome, it's time to slow it down here. It's time to go back to print, baby, print. A Fed pivot. Are you sick and tired about this whole baloney about a Fed pivot? I am so sick of it. It is the most moronic thing I've ever heard of. But anyways, the bottom line is, for the market, bad news is good news is bad news. In other words, the market is looking for not a super bad jobs report, but a slowing down. They want to see a slowing down in the employment. So some job losses here and there, that's good, at least according to the market. But see, the market wants one thing, and the Fed wants another. And the Fed is in charge, and that's all what matters. So while the market might be looking for, okay, job openings are going down, here comes the pivot. The Fed says the pivot is not happening until we see unemployment rising higher, let's say to 4%. And we need to see inflation to go down significantly, and most importantly, consistently, before a Fed pivot happens. So the stages of unemployment rising higher, stage number one, job openings start to go down. And we've heard about, company X, company Z is taking jobs offers down. That's step number one. And now we're seeing the results in job openings. Step number two, we see hires going down. In the last few months, we've heard many companies saying that they're going to slow down hiring. For now, we're not seeing this being translated in the data. Matter of fact, hires are going higher. So it's going to take time before we see this data in hiring. And it's going to take consistency by the Fed to keep financial conditions tightened so we can see these results. But once the Fed pivots prematurely, job openings will go higher again, hires will go higher, inflation will go higher, and what is the point here? But step number three, after hires go down, the rate of unemployment starts to go higher. In other words, we start to see major layoffs. But all of that's not going to happen if the Fed pivots. You might say, this is good, Maverick, for the economy. Who wants unemployment? But the problem is, if the Fed pivots right now, inflation will also go higher. But we know if the Fed keeps at the same pace right now and they don't waver, we're going to see layoffs coming. We're going to see unemployment rising higher for sure. Job openings are going down. If the Fed continues, hires will slow down. And then this kind of data, for example, what we got today, Peloton cutting 12% of the workforce, this is going to start to show up in the unemployment reports, maybe at around December or even 23. In other words, we have a lag. So is the unemployment rate and job losses are going to start to appear in tomorrow's report? Doubtful. If anything, we're going to see job creation in the economy, but we might see small pockets here and there as leading indicators that the unemployment rate is about to rise higher. And again, bad news for the economy equals good news for the market because the market thinks that the Fed is going to pivot based on this data. What the market doesn't realize is the Fed is going to pivot at some point, but they're going to pivot for the wrong reasons. They're going to pivot because the economy is collapsing, and we have already hit the financial accident, quote unquote. For now, look at companies like Facebook with massive layoffs. What's going on in Zuckerberg land is absolutely stunning. You see, when a company's stock collapses the way Meta stocks did, you're gonna see the results being translated into real life, meaning the company moves from capital expenditure to capital preservation. Capital preservation means lowering expenses, and the easiest way to do that is getting rid of excess employees. Of course, with the lunacy of Mark Zuckerberg and the obsession with this glorified video game we call the metaverse, or he calls the metaverse. But anyhow, this means that the company has to manage its expenses. If they're going to spend billions and billions of dollars in the metaverse, they cannot afford to continue to hire all of these employees. So we're going to see a tsunami of layoffs in Zucchini land. And a lot of folks say that Meta stock is cheap. Give me a break. This company is at risk. It sounds crazy. Come on, Facebook is going to collapse now. You're a perma bear, Maverick. You think I haven't seen this movie before? When people said, oh, this company is never going to go down, and it went down anyways. These technology companies can go down in an instant if they make the wrong decisions and they continue to make the wrong decisions. And this is the case with Meta. But the bottom line is we're seeing unemployment news from companies. And this will be translated in the data in the next few months. Can't guarantee it's going to happen in tomorrow's report, but we might see signs of that happening. And a leading indicator, we just got this, Tuesday, Wednesday, the ADP report. This is for the private sector alone. Now, all in all, according to the ADP, the private sector of the economy created about 208,000 jobs in the month of September, but we have signs for weakness here. When we look at the goods producing sector of the economy, it actually lost 29,000 jobs in September. The services sector remains hot, but we also see pockets of weakness in information, for example, which lost 19,000 jobs last month, and financial activities. With the market down, we're seeing a lot of financial advisors getting the boot. Goodbye. And they lost 16,000 jobs. But we're still seeing hot spots in the economy, mainly because this is an Amazon economy. That's what it really is. When we look at trade and transportation, utilities, 147,000 jobs were added in the month of September. In professional and business services, 57,000 jobs were added. And this one, in my opinion, will be the sticky part, meaning you might see job weakness in even trade and transportation in the next few months, but education and health services will remain hot. In September, this sector created about 38,000 jobs, and my hunch is it will continue to create jobs, and we will continue to see wage inflation here. Number one, when it comes to health, the aging population, you need more and more social workers, nurses, etc. We have a shortage in those already, meaning wages will continue to move higher. Seniors are not going to stop getting sick or die because we have a recession. Likewise, when it comes to education, you're not going to take your kids out of school because we have a recession. And we have a massive teachers and educators shortage, meaning wages will go higher in this sector, number one. And number two, with kids coming back to school since the thing is no more, the demand for teachers will go higher and higher and higher. And then we have leisure and hospitality. This one is slowing down, and it created 31,000 jobs in September. Now, all of these jobs in leisure and hospitality will go down so fast you're not going to even believe what's going on. As the economy slows down, as consumer spending slows down, as we see the rise in unemployment, well, the number one thing people cut spending on is eating out, traveling, leisure, that kind of thing. And on top of that, you have air travel companies and cruises that happen to be over leveraged. And that means with interest rates rising higher, they're going to have an insane amount of trouble, and they're going to have to rid of employees so fast, specifically those employees with the inflated wages. Now, we're still with the ADP report here, and we will look at the regions. New England was the weakest region, down 11,000 jobs in September. But the South Atlantic, I believe that's Florida? 57,000 jobs were added over there. And then we have in the West, the Pacific, created about 64,000 jobs. And what's really confusing here is you see a lot of sectors down in jobs creation in September. But then we see businesses from all sizes, be it small, medium, or large, creating thousands of jobs. Even small businesses, because last month, meaning August, small businesses actually lost jobs. In September, they added jobs. So I guess all of them are now working with Amazon. Anyways, and then we're still with the ADP. Let's look at some wage inflation data. Here's what's really important. I don't think the market is going to care about the jobs number. We know that this is a lagging indicator. I think the market is going to look for wage inflation. If wage inflation goes higher by a lot, month over month, forget about it. The market is going to go down big time. But if wage inflation slows down, even if we see a hot jobs report, if wage inflation goes down month over month by a lot, the market will blast higher either way. So the leading indicator that we have here is the ADP report. And listen to this. It says job changers lost momentum in September. Job changers, who have been notching double-digit year-over-year gains since the summer of 21, lost momentum in September. Their annual pay rose at 15.7%, down from a revised 16.2% gain in August, and this is the biggest deacceleration in the 3 years history of the ADP data. However, before we start jerking off, here it is. For job stayers, annual pay rose 7.8% in September, up from a revised 7.7% in August. So job changers, wages are slowing down. Job stayers, wages are moving higher. And I tweeted this today. I don't think the market will care about the number of jobs created in tomorrow's report. I think all eyes will be in wage inflation. With the shortage of teachers nationwide, I expect wages in the education sector to rise markedly. And I know a lot of teachers watching the program tonight, they say, what wages, man? What are you talking about? We're poor here. Wait for it. and bargain for it because it's going to happen. They need you. They got no other choice. All of these kids coming back to school and the teachers are not here. And I know we got the Pink Floyd, leave the kids alone. I get it. But these kids with the TikTok and all the stupidity they're getting exposed to, they need teachers. And this will increase the demand for teachers and wages will go higher. No doubt about it. Okay, so far we have some indicators that the jobs market is indeed slowing down. Is it by a lot? Is it to the Fed's taste? Not really. But most importantly, are we seeing wage inflation slowing down? The answer is not really. Job hoppers, wages are slowing down. But job stayers, wages are moving higher. So now here are the expectations from tomorrow's employment report. The analysts and the economists are expecting 260,000 jobs versus 315,000 jobs in August. And by the way, watch how they're going to revise the number for August down. Big time. Nobody's going to notice that. Did we say 315,000 jobs in August? Whoops, we got it wrong. It's actually 175,000, okay? But now they say that the number of jobs will slow down from 315 to 260,000. We'll see what happens. But the expectations for the unemployment rate is to stay the same at 3.7%. And for the average hourly earnings, month over month, this is the most important number to watch tomorrow, in my opinion at least, 0.3%. If it goes above 0.3%, we're going down, baby. But if it is below 0.3%, specifically by a lot, the market will go back to the moon. And then we have average hourly earnings year over year. The expectations are 5% versus the 5.2% in August. And here's what's really important. When people talk about the jobs report and what's going to say or not say, what that means about the Fed pivot, because the market right now is looking at every single piece of data from the perspective of, does this make the Fed pivot or not? And if it doesn't, down we go in the market. And if it does, up we go. And the market disregards what the Fed is saying. The market says, we don't care what the Fed is saying. We're just going to look at the data and make our own assumptions, whether the Fed is going to pivot or not. For example, today, the demon from Minneapolis, Neel Kashkari, and by the way, he watches the show, so how you doing, Neel? He came out today and said, and I'm quoting here, quite a ways away from pausing on raising rates. Forget about cutting rates. That is a stupid fantasy. The best case scenario here is a pause. And Kashkari says, we're not even close. Now, you could say that Kashkari is lying or he's bluffing or whatever. And I get that because the Fed lost a lot of credibility. And a lot of folks say that, hey, Neel is a dove. He was one of the top doves before. And he argued for quantitative easing, that it is morally good. It doesn't matter if we destroy the American dream and make everything expensive and all of that. And we make the rich richer, the 1% richer by fluffing up real estate and stocks valuations, but so long as some of that trickles down and creates jobs here and there, the price is worth it. That's Neel Kashkari before. Now all of a sudden he says, oh, wait a minute, I want you to lose money. I want to see the stock market down. I'm all in puts, and I'm losing money, damn it. Now, I don't know if Neel is bluffing or not, he's bullshitting or not. All I know is, it's a matter of choice. And the Fed has no other choice right now but to continue to raise interest rates higher. Otherwise, inflation will come back bigger, stronger, and with more viciousness. They know that, so they have no other choice. They're late to the game, and this is the price to pay. And of course, you got Scott Wapner from CNBC says, hey, Neel Kashkari says that there is almost no evidence that inflation is going down or peaked. But there's actually a lot of evidence. And look, I'm not taking a shot at Wapner here. I think he's one of the best presenters in CNBC because at least he attempts to challenge the pumpers who come on TV every day and say, oh, the stock market is going to go higher because fill in the blank. Please buy. We need our bonuses now. But in response, I said, look, the evidence for inflation going down is nothing compared to the evidence that inflation remains a problem. It continues to go higher and it remains sticky. So if you're looking at one perspective alone by saying, hey, prices paid in the services PMI went down, that's an indicator that prices are going down, inflation is going down. On the other hand, the overwhelming evidence says core PCE went higher month over month. Food inflation is insane. The inflation in car prices is insane. The inflation in housing prices remains beyond insane. And this is where the overwhelming evidence resides. But then they counter and say, oh, but there's a lag. The Fed is doing so and so right now. And this is not going to show up in the data till next year, so the Fed has to stop right now. Big mistake. And the only people arguing for that are people with a dog in the fight. And their dog in the fight is, the year is coming to an end, it is a horrible year, and all of these money managers are not going to make bonuses. They're down year to date. So this is pumping season. It's the fourth quarter, the last chance to secure these bonuses. And of course, they're going to come on TV and pump the stock market for whatever reason. And the dumbest reason among them all is the so-called Fed pivot. And lastly, before we move on to the stock market coverage, folks, I hope you understand the severity of the unfortunate position that the Fed is in. And of course, it is because of their own wrongdoing. We know that. But they're now facing three major problems in the economy, and they have no other choice but to watch the wreckage in the economy. They're facing three monsters. We talked about inflation. Inflation is sticky. It continues to go higher. It doesn't want to go down. And it's going to take a lot of fighting, a lot of firepower by the Fed to defeat inflation. In doing that, interest rates will rise significantly higher, and that creates monster number two against the Fed. And this monster is financial risk, that something is going to blow up, either here, overseas, and this something might be contagious. But can the Fed stop the fight right now because this risk might happen? Doesn't make sense at all. They're only going to stop after it happens. And then monster number three is the recession force. As they continue to fight inflation, they're going to dip the economy into a recession. We're seeing some of the best companies in the world, the leading growth companies in the world, such as AMD, now saying, hey, we're going to lose $1 billion. PC sales are dropping like we've never seen before because the economy is heading into a massive recession. The demand is going to get crushed for PCs because all of that spending is going to go to gas, utilities, rents, mortgages, grocery store, etc., etc. Inflation is pushing the economy into a recession. Inflation and the fight against inflation is adding to the risk of a financial accident. The bottom line is, this is a really risky environment, folks. The Fed is facing three monsters: inflation, the recession, and the financial risk. You really think the Fed is going to win without creating massive damage? Think again. And here's the last take regarding the jobs report. I said market bulls are in a stage of confusion and delusion. If the jobs report comes out bad tomorrow, they'll say, you see, the Fed pivot is coming. You gotta buy stocks now. On the other hand, if the report comes out strong, they'll say, see, the economy is strong and it can handle Fed rates. Bye. This is delusion. This is desperation. We don't want to accept the reality that the party is over. And with that, folks, let's move on to cover the stock market information for you. We start with the closing of the indices today. And here we go. The Dow Industrial Average in the red, down by 346.93 points, or a decline of 1.15%. The Nasdaq down by 75.33 points, or a decline of 0.68%. The S&P down by 38.76 points, or a decline of 1.02%. When it comes to the sector's performances, pathetic across the board, with exception of energy at number one, capturing the gold, the silver, and the bronze. Can the outperformance last? Well, we know there's a put in oil prices, and this put comes from OPEC+. I was supposed to talk about OPEC+ tonight, but I don't have the time, so we'll do that over the weekend, or we might actually do a Friday show. We'll see. But to me, the most troubling finding here is, look at the sectors leading the declines today. Utilities, REITs, financials. Forget about financials, but utilities and REITs, these are defensives. They're supposed to hold right now. Dumping those is either a sign that money is migrating to the risk-on technology, chips, etc., but we're not even seeing that, or money's migrating to cash because the expectations are yields are going to blast higher, significantly higher, and utilities and REITs will lose their appeal of having dividends and high yields because you can't compete with the fixed income. Anyways, the advance to decline ratios, NYSE 27% advancing versus 70% declining. The Nasdaq 39% advancing versus 57% declining. On to commodities, yet another positive day for crude, the WTI, Brent, all up above 1% for the day. Gasoline RBOB with gains of about 1% for the day. Heating oil with massive gains of over 5%. And then natural gas pretty much in the flat line. The OPEC put is here, but OPEC Plus is not the only force in this dynamic. You got the Joe B administration now saying, hey, we're going to do the no OPEC thing. Get it? The no OPEC thing. And then you got Jerome Powell, who has to fight against this by being even more aggressive. And now we have a fight between OPEC, Biden, and Powell. We'll talk about that in details in the OPEC Plus video. But for now, when it comes to softs, we have gains for lumber and sugar, while we have declines for OJ, coffee futures, and cocoa, while cotton was pretty much in the flat line. When it comes to metals, the dollar is up above 1% for the day, and therefore we're seeing copper down, losing about 1.75%, but gold muted, palladium muted. On the other hand, silver and platinum managed to bounce higher, not by a lot, about 1% or so apiece. Meats, muted action for live cattle futures. Feeder cattle futures down by a little bit. And here it is, the new big tech lean hogs, scoring yet another day worth of gains of about 1.5%. Grains down across the board, soybeans, soybean meal, corn, wheat, oats, rough rice, canola, all down. Yet we have a rebound in soybean oil futures worth about 1%. All eyes on the dollar, all eyes on how the dollar is going to react tomorrow, and this will have a positive or severely negative impact in the commodities market. Dollar goes down, commodities are going to pop higher. Dollar goes up, commodities go down. But look at the resiliency in oil and energy. So if you have to pick a corner here, of course you're going to go with oil, specifically if the dollar goes down, because now you have two forces working together to pump oil higher. The dollar going down and OPEC having a put on oil prices. They're not going to let the oil price go down below, let's say, 85. Moving on to the big casino, the options market. What's going on here? The volume went down significantly for the day. It was an anemic day when it comes to volume. Really boring to watch the action, but the volume will come back tomorrow. No doubt about it. But for now, the hottest table by far was the souffle, Tesla. With about 2 million contracts traded today, about 55% of those were calls. We're waiting for a bounce in Tesla. Either a bounce or a massive flush down. How would you know? Wait for the charts analysis. But at number 2, Apple, with around 1 million contracts traded today, about 52% of those were puts, not calls. Number 3, Twitter, at around 800,000 contracts, with about 51% of those were calls. On to the unusual activities that took place in the options market today. Listen to this. This one is the most important one. For the Qs, the Nasdaq, somebody's making a major bet that the Nasdaq is going to pop higher. They bought the 295 calls for the expiration date November 4th, with expectations that the Nasdaq will gain over 5.5% by then. They paid around $4.50 a piece to enter this trade, all in all spending around $15 million. And then we have the ticker SYF for Synchrony Financials. Yesterday we talked about the risk against Capital One. Synchrony is another name that could blow up from all of this risk that's going on in the economy. Somebody bought the 28 puts for the expiration date, November 18th, with expectations that the name could move down and lose more than 11% of its value by then. They paid around $1 a piece to enter this trade, all in all spending around $2.5 million. And lastly, this is the contrast. Somebody bets $15 million that the Qs will go higher, but somebody bets that Apple will go down. Well, the Qs will not go higher without Apple, that's for sure. And somebody's betting that Apple will go down further by buying the 135 puts for the expiration date, November 11, with expectations that Apple could go down and lose more than 7% of its value by then. And they paid around $3.50 a piece to enter this trade, all in all spending around $2.4 million. On to the heat map. What's going on here? Again, the same theme as yesterday. Really alarming that we're seeing utilities, REITs, even the big pharma, and the consumer defensives, the staples, also getting shot big time. Either this is a migration from the defensive to the offensive. Are we seeing this in the map today? Of course not. Apple is down, chips are down, tech is down, all of these speculative names are down. So either the money is moving out, waiting for, let's say, a piece of data, the jobs employment report tomorrow, so they can buy tech and risk on, or this money is going out because we're going down across the board. And this time around, even the defensives are not going to hold. But you know what's holding right now? Energy. Energy up across the board with few exceptions here and there, but names like Exxon, Chevron, Occidental, and two names I'm still involved in, Devon and SLB, Schlumberger, all leading the gains today. Now the heat map will be extremely important in tomorrow's action because we want to see where the money is migrating. Is it migrating out of the entirety of the stock market, or are we seeing a rotation here from defensive back to offensive? We'll know tomorrow for sure. In the meantime, here are some corporate news for you, most importantly for Twitter. The Elon versus Twitter saga getting really confusing. I read the news that the judge gave Reverend Elon all the way till October 28 to close the Twitter deal. And then I read that the judge postponed the Twitter Musk trial after the company accused him of mischief and delay. Uh-oh, it sounds that the deal is about to fall apart again. Anyhow, here's the heat map for the ETFs. Down across the board with exception of commodities, energy, XOP, XLE, OIH, all in the green, even gold, GDX in the green, and the weakness once again in the ultra-defensive ETFs. We're talking about the XLU, utilities, XLP, staples, IYR, REITs. Either of these are going to rebound significantly higher tomorrow if we see yields going down in reaction to the employment report, or this is the beginning of something, the beginning of a massive leg to the downside for the entirety of the stock market. If we have Apple and Tesla going down, if we have the defensives in utilities and REITs going down, is there anything left here? Anyways, moving on to the charts, and we start with the SPY 30 minutes chart. What do we see here? We have consolidation, boring action, but the chart kept the support at around 373.5. This is the good news for the bulls. The bad news is, number one, we have a negative divergence in the RSI indicating weakness. And number two, the bears would argue that this is a bear flag formation. It is already playing out, but the bulls will counter and say, who cares about the bear flag? Who cares about the negative divergence? All of this is a process of gathering energy before the next pop higher. You know why? Because the larger formation is of a bull flag. And if that is the case, then the next stop is 385. Who has the better case here? I would say the bears 60 to 40. So not by a lot, and it all depends on the jobs report tomorrow. And what about the daily chart for the continuous contract for the S&P 500? Who has the advantage here? Well, let's see. Number one, the chart remains above 3,720.5 as support. Number two, the volume, it remains below average. This is a good sign for the bulls. Number three, the momentum indicators are firming up and they're now becoming positive, not negative. Another good sign for the bulls. And on top of that, the bulls would argue, look, we have a crossing in the MACD. We'll also have what it appears to be, even if we have a pullback, let's say, in reaction to the employment report, we have what it appears to be a beginning of an ABC pattern. Now, can the bears argue against all of that by using only the technicals alone? The answer is not really. The bears will counter with some fundamental reasoning. Oh, the jobs report will come out hot. Oh, inflation will come out hot. Oh, this is a bear market bounce. And then we see the dollar and yields moving higher, and the stock market goes down. But from a technical perspective alone, who has the advantage in this chart? The answer is clearly the bulls. Here it is, the Q's 30 minutes chart. What's going on here? Boring, flattish, keeping the support at around 280. The bears would argue we have negative divergence. This is a leading indicator that down we go. And if down we go, we have closing the gap at around 274.85. The bulls would argue this is a bull flag formation. If it is, higher we go to 290. Who has the advantage? Well, the bears would argue we also have a bear flag formation, which will take us all the way down to 274.85. I say nobody has advantage here. It is 50-50. And of course, the employment report will be the judge here. The daily chart for the continuous contract for the NASDAQ, what's going on here? Unlike the SPY, this chart has yet to gain any key support beyond the June bottom. It is below the important resistance of 11,689. The volume is actually moving higher, above average, not lower. We still have what it appears to be a negative divergence in the RSI, yet the MACD indicator is lining up green, indicating positive momentum for now. The bulls could argue that this is a bull flag formation, and the employment report will be the key to unleash the bull flag, which will take us above 11,689. But right now, today, as we speak, who has the advantage technically speaking? The answer is the bears slightly. So we have a divergence here, where the SPY looks a lot better than the Qs, and the reason is the outperformance of energy. What about the IWM? What's going on here? Again, consolidating at around the support/resistance at around 174.22. The bears are going to argue that this is a bear flag formation. It's already playing out. We have a negative divergence on the RSI. The bulls are going to counter and say, what are you talking about here? The chart is still holding support. It is gathering energy, and this energy will be released to the upside once we get the key to unlock this energy. And this key will be the non-farm payrolls coming out tomorrow. The Dixie, what's going on here? Now, I have to apologize and say my bad, because 111.2 means nothing at all. I got the number wrong. The chart went below it and then reversed, went above it, like it's nothing, like it doesn't even exist. And that tells us that the number doesn't mean anything at all. So we'll take it off. And what do we see now? Well, the bears are going to argue, look, we have a crossing in the MACD. We have negative momentum according to the MACD. We have a negative divergence in the RSI. So down we go, despite the rebound that we got in the last few days. But dollar bulls are going to counter and say, what if this is an ABC pattern? We got the A leg to the upside, we formed the B leg to the downside, and now the chart is forming the C leg. This is certainly something to watch for, but who has the advantage right now as we speak? The answer is dollar bears, not bulls. The bulls need to do a lot more to get us to believe the ABC pattern. Gold, what's going on here? It is consolidating in a bull flag pattern, waiting for what? Waiting for the dollar. If the dollar goes down in reaction to the employment report, then we will see the bull flag playing out in gold, and vice versa. If the dollar goes up in reaction to the employment report. The bull flag in gold is not going to play out. We will go down here. Perhaps gold will lose support at 1,685. Here's Brent oil, the daily chart. And so far, since the breach above the sloping line of resistance, we have a massive rally worth at least about 7%. But it is now facing some resistance, not a lot. If it is a mini pullback and then we see a rebound higher again, you gotta go long oil because we have a confirmation that we have bullish momentum and it is really strong. But if we do have a pullback, we go down in the territory of 85, this will be bad news that despite the tailwinds of OPEC Plus, oil doesn't have what it takes to create a rally. What about a daily chart for the 10-year yield? What's going on here? Clearly, the momentum remains negative. We have a negative divergence in the RSI. We have negative momentum, according to the MACD, at least in the daily chart. But the bulls will counter and say, we got an ABC pattern. It's done. Bond bulls are done. And now what we're seeing is a bounce back, and the chart is already above the top of the breakdown candle, meaning we have a reversal here, and yields should go higher from this point on. TLT, a weekly chart, what's going on here? Looking at it right now, in my opinion, it is melting down, and the bleeding is not going to stop here until we see a legitimate Fed pivot, which is not foreseeable right now. The VIX, watch out for this one, 4 hours chart. This is the most alarming chart for the bulls. The VIX is moving higher. Despite the massive rally, it didn't go down by a lot. It is consolidating underneath 33, gathering the energy to pop higher. And now we're seeing positive momentum in the VIX. I would say this is the bear's most important evidence that the market should go down. And then we have Apple. What's going on here? It appears that Apple is stalling, but it is keeping important support at 145. My hunch is the volume will move higher again, and sooner or later we'll see Apple closing the gap at around 142.45 before it goes above 150. So in the battle of does Apple go to 150 or close the gap at 142.45, I'd go with the latter. I would say, hey, the battle of 150 already lost. Now it goes down to close the gap. Tesla, an hourly chart, what's going on here? We have a triple bear flag formation. If it does play out and the chart loses 233.33 for good, meaning a weekly closing below that, the bears must double down. But if the chart keeps this support by the end of the week, you might do the opposite. You might want to close your shorts and go for a rebound trade instead. And lastly, Bitcoin, tulips, what's going on here from a 4 hours chart perspective? The good news is the chart is still battling 20,000. It is keeping 20,000 right now as support. Back and forth, back and forth. But we have a double top formation. And this is not the third, but the fourth time that Bitcoin is stalling at 20,000. It has been asking for buyers over and over and over and over again. Maybe the buyers are waiting for the employment report to get out of the way and then they buy. Okay, we'll play that game. But if they don't show up after the employment report, what are they waiting for? The sellers are going to show up and you will see the chart flushing down. Anyways, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? In case you were asleep throughout the video, we have the most important non-farm payrolls, which comes with the unemployment rate, the average hourly earnings, and the labor force participation rate. And then we have consumer credit and a bunch of Fed zombies speaking. Most importantly, in my opinion, is Kashkari, the demon from Minneapolis. We'll see what he says tomorrow because he said last time that he was happy the stock market went down in reaction to the Jackson Hole speech. What is he going to say now? Until then, this is all I got for you for now, folks. Thank you for listening. Thank you for watching. Now we'll talk to you again over the weekend.
Look at these numbers. See these? These are stock prices over the last 3 months. See these drops? Get used to it. It's just the way the market works these days.